the efficiencies, I guess I look at it as, all the work that the guys have done, is incredible in terms of giving us the ability to move money from one place to the other. That's going to stay. The endpoints in that infrastructure are going to stick around because at some point you're going to want to get out to cash. But with the blockchain and with the Bitcoin network, you're building out a network where you can have sort of like best routing algorithms plugged in and figure out what is the best optimal path to get money from one place to the other. And then the other thing I think, and we've noticed this you don't notice this in the developed world because we have great ways of buying coffee at Starbucks. I mean, I can think of like 5 different ways in the morning to do that. I don't want to reach out to my Bitcoin wallet and figure out how to scan it and do this, and I'm just like, okay, I just want a coffee, just give me coffee today. But in the developing world, we're seeing situations, Pantera, some of our investments in Argentina, people are going out of their way to buy Bitcoin. People are going out of, merchants are going out of their way to take US dollar credit cards and get them into Bitcoin because the taxes on receiving pesos are so high that they're trying to get out of this. This is the regulatory arbitrage I'm talking about. They're trying to get out of the system. And now what's emerging is people are providing other services that you can consume with Bitcoin. There's some ISPs that allow you to buy with Bitcoin. There's web designers that accept Bitcoin. So you have hotels that are taking a whole bunch of Bitcoin and some of it they're storing and then others that they're using. And they're essentially stepping out of that system. So if you think about that idea of remittance, is that if you have to do less to get the physical cash out and more just to receive some digital token, then maybe that's a different way of thinking about remittance. And on that point, I think you'll also see, we're seeing more and more companies come out with Bitcoin as less a thing that consumers even know about. It's pesos or US dollars, but actually Bitcoins, but they come with stabilized contracts so that people don't even know they're using Bitcoin.
Right, I was actually going to mention that too. What's really neat about Bitcoin, and today there's been kind of this like distributed ledger versus Bitcoin debate that we've kind of seen on stage. What's really neat about Bitcoin is that as money moves onto the ledger, you gain some really cool efficiencies with network effect. As more money moves onto the network, as projects, I think Adam Pellenstein spoke earlier about Counterparty. I think in Mirror. But there's a number of people who are doing like digital assets on the blockchain, and what that allows you to do basically is send messages on the blockchain that can actually decompose to their value, which is kind of neat. Like you can send someone the value of $1 on the blockchain, or you can send someone a Bitcoin itself. And on its face, that doesn't sound so important. But for someone like you, what I would think that means is you can actually interact with people with untrusted nodes in that network. You can send those nodes, or they can send you actual value. So you don't have to trust, you don't have to be as trusted as you would in this current network, where you have to have like absolute trust from beginning point to end point.
My concern with that is, and maybe you can help me through this, is the remitter at the beginning end is easy. We're going to know who they are. They want to start with Bitcoin. We'll ask them all the questions to make sure we have know your customer satisfaction. My question is, how do we deal with that on the other end? Because obviously on the beneficiary, if it's going to some computer address, I'm in the dark as to who that person is, if that person is named on OFAC, if that's someone who's a beneficiary who I have a problem with. How do I verify that person who's receiving that good thing?
The last mile problem is one of, in my understanding of remittance, the last mile problem is one of the hardest problems to solve. And I would say that the example of like a BitPesa is probably a really interesting way in which that is solved, where you're actually sending value directly to the customers, which is real interesting. But usually last mile is like you're remitting in like paper, right? So I'm not absolutely sure how you would deal with that in the last mile.
I guess when that gets solved, then the remittance companies will jump into this until we can get that solution. That's what's going to hold us back. On the other hand, as I think Chris and I talked when we first started this, what I'm hoping this conference triggers, as well as we have this, particularly here in the bid license, we already have the money transfer license that the companies similar to us in the field and the expertise in looking at this stuff, but the expertise that the fintechs bring to this, because of what you know about how we could possibly make it more efficient, potentially simplify the AML reviews that we do, make them quicker, make them more automated and less manual, because we get nervous because you heard I have a zillion regulators in and out of my office, and talking about anything Bitcoin, they like their hair jumps. Yeah, so we need more satisfaction from you guys to confirm that you've got how you do this, and maybe even kind of like with accountants, that you've got an outside due diligence standard that you're meeting, that they're approving, that will allow us to work together to make it cheaper and quicker for the customers on both sides.
And to that, the last thing I would say on this question personally is that the way it's felt for, I think, a lot of people in Bitcoin is that Bitcoiners are like trying to tunnel into the banking industry a little bit, like secretly, and bankers are like building a bridge into Bitcoin, and bankers don't know much about Bitcoin, and Bitcoiners don't know much about like banking or remittance, and I think the venture capitalists are kind of caught in the middle.
And companies like us can be the bridge, because we are comfortable with them both. But I have to say to the bankers in the audience, and they already know this better than I do, the minute you go to, and so I wanted to ask Blythe, who was here first thing this morning, who worked at JP Morgan, if you go to a bank like that, and we have enough issues with our own banks because they consider us a level of risk that they need extra due diligence on to make sure they're even going to allow us to continue to have a bank account with them. You mentioned that you're dealing with Bitcoin.
It's right up, yeah.
It's over. So that's a practicality we haven't talked about today of convincing the bankers of the world that dealing in Bitcoins and exchanging Bitcoins is something that they should be able to trust. And we can give them enough due diligence to allow them to trust it, which I kind of put on the industry, and you three guys sitting here, to do something to build up as much as you can that kind of trust so that we can take it to the next level.
I feel like the negotiations have started right here at the table right now. Let me just back it up real quick. Josh, it sounds like at the end that I asked what the efficiency of Bitcoin was, you felt that it was regulatory arbitrage, presumably in the same sense that the internet was for companies like Uber and Airbnb. Is that a good synopsis?
Yeah, I think there's a lot of. I think that the shared economy is showing how much money there is in regulatory arbitrage. Where I mean, if you think about what Uber is a taxi service. I mean, they're
They provide insurance for unregistered
drivers. But that's what their actual business model is as like an insurer. So they go in, they calculate the risk of getting caught as a taxi without a license, and then when you get caught, you get fined. Uber, covers your charge, and you go on your merry way and continue taxing. And that Uber literally is going city to city, jurisdiction to jurisdiction, and telling everyone like, well, you can go ahead, like we're abiding by the law, the letter of the law, not the spirit. Good luck. And there's a lot of, now what are they now? $30 billion. There's a lot of money in regulatory arbitrage. Uber's finally is proving that. Airbnb is proving that. The difference between them and Bitcoin is that Bitcoin doesn't have a center. So that makes it very unique.
And to summarize, Steve, it sounded like the network effect even was a big part of what you felt the blockchain was good for, and that perhaps the blockchain as a public utility offered an efficiency. Is that a good synopsis, or did I misquote you there? Sorry. Do you believe that Bitcoin has value and offers efficiency as a public utility? Presumably in the way that the internet does.
I think that's a good analogy. In the same sense that the internet is public utility.
If you had a TLDR your answer to the efficiency question, what would that entail? It's a quick 1 second.
TLDR is too long, didn't read.
I'm not sure I got a tagline on that one, but I guess I think the interesting aspect of remittance is going to be when we see people just really transferring digital value and currency more frequently, and until then we'll sort of be snipping away at the remittance space, unless you're dealing with much more efficient spaces like the commercial remittance space that we're focusing on right now. I think to answer your question about, or your comment about the banks, I think that what we've noticed is that financial institutions, at least on the market side and the infrastructure side, are increasingly embracing. They don't want to talk about Bitcoin, talk about blockchain instead. But then you explain that the Bitcoin blockchain is the most secure one, and they're like, okay, we'll use that later when the Chinese and the Russians are mining it. And so we're seeing a strong shift, especially even from a year ago, to people understanding what's going on there. I think that will, in the end, convince the retail side of the banks to allow some of our companies to get bank accounts more easily.
So let's dig into the next question. There are companies that are already issuing US dollars on the blockchain. Tether is one such company. T0, which I believe is the new name of the Overstock company, is also doing this. These are dollars, these are assets that are issued onto the Bitcoin blockchain and they're transmitted using Bitcoin as a payment rails. Now, in your mind, Ron, how does that fit into the regulatory structure? Are these assets, should they be fungible, available in your mind for redemption then? How will regulators respond to these things which are already issued in terms of turning them into ACH messages or actual paper?
Okay, of course, I've never been a regulator, though I've dealt with many of them. I would say, yes. I mean, the FinCEN, it goes back to that FinCEN guidance, where they basically decided not only that Bitcoin qualified as something of a monetary value and therefore was going to fall under every statute as if it were the same thing as a dollar, but any other kind of currency. And also, they went a step further that anyone who is dealing with exchanging the funds in any way is also somehow a money equivalent of a money transfer, which is why they got subject to all the state statutes. So as a result of that, I would say yes, the regulatory framework is going to call that a money transfer. The minute, not the issuance of it, but anytime it's going to be put in anyone else's name or any other entity's name. So at that point, they're going to have to register with FinCEN and get a license and go through all the 9 yards. It's a huge hurdle. That's why there aren't as many of us in the arena as there are because of those hurdles. And they've gotten bigger every year through nothing to do with us, but only because the regulators have made it harder and harder and more demanding and more demanding. One thing I also, in addition, it's on my mind, so I don't want to forget it when we said it, but I want to say is an issue for us using any virtual currency, but Bitcoin comes to mind as the first, is because under the law and the regulations, that you must tell the remitter at the time the transaction occurs exactly how much currency in the foreign currency, if it's not going to be a US dollar to US dollar, the beneficiary will be picking up. And if you're going to put in Bitcoin, then you've got to, at that point, promise, I'm going to give you X number of pesos, but you don't know when the guy picks it up exactly what the value of Bitcoin is going to be and how you're going to manage that currency. So you're taking a risk that you're going to have enough money to meet that if there's somehow a terrible devaluation or increase in valuation of either Bitcoin or that foreign currency. So you end up having to hedge a lot. And I'm not sure, I mean, that's what we do every single day with our currencies. Again, it makes business much more complicated for us, but we do it because most people pick up their currency, the remittance that day or the next day, so it's really quick. But if you add in one more currency change, again, it just complicates the matter because of the regulatory requirement that you've guaranteed them how much in a foreign currency they're going to get.
You know, just from personal experience, I remember Bitcoin before regulations, and it wasn't fun. I'm a little atypical in this respect, but all of you have seen and heard of the Mt. Gox event. And I don't know, did you know much about Mt. Gox, the implosion of this?
I read all the case materials.
Wonderful. So it seems like after that event that a lot of American companies, I think, saw the need for regulation, and we pushed forward through a regulatory structure that allowed insurable and auditable institutions like Coinbase and these guys. Do you think that that same level of event is needed for these assets on the blockchain, or do you think that that would just die and never be adopted by a regulator?
They're going to resist it. I mean, you can do it. I mean, part of the difficulty, I'm sure, that Mr. Lawsky and the whole New York State Department had, every state, getting more of an education and remittances probably than you wanted, requires in addition that you have a security bond. And that bond is meant to, it's paternalistic. It's meant to, if you go out of business, or for whatever reason don't have enough money, that there's an insurance company behind you that will pay the beneficiaries or refund to the remitters any transactions that weren't paid. And the way they value that